Okay, welcome everybody. Thank you so much for taking time out of your day to join us for another edition of the Quarantine Broadcast. I think I should probably start renaming that as we get out of quarantine in certain different jurisdictions. Today, we're happy to have a good friend and also a guest speaker today, Jonathan Garbutt, who's a principal with Anderson Tax in Alberta. Jonathan, thank you so much for taking time out of your day to join us.
No problem.
Cool. So today we're going to be talking about everything to do with capital gains taxes in Canada. Are they going up? Are there things that you can do about it? So really just wanted to jump in quickly here on the basics on how do capital gains actually work in Canada?
Yeah, that's one of the things that makes Canada a little bit different, particularly versus the States, is that there is really no capital gains tax rate. What we do in Canada is, if let's say you bought something for 10 and you sold it for 100, we would include half of the gain, which would be 90. So we'd include half of that amount in your ordinary income, or $45. And then that $45 would be taxed to your ordinary rate of income. So it effectively amounts to whatever the rate that you'd be applied at for the year, or half of that rate. So for someone in Ontario where the top rate is 53.53%, capital gains, they're making a lot of money, they're doing very well. The capital gains rate would be effectively half of that, sort of 27%, just below 27%. So that's how we do it in Canada. It's different than other countries. And so you always have to take that into account.
Absolutely. Thank you for the explanation. So I guess on that note, do you think that they're going to be going up anytime soon in Canada?
Well, every time that the government goes to propose another budget, every time the government goes to make an interim financial update, there seems to be this raft of speculation about whether or not they're going to increase the capital gains inclusion rate. I take it from 50% to 66%, or to 75%, or even 100%. And that talk always perks up every time there's a new budget. Now, this in many ways makes sense to me, because personal tax rates on income are already extremely high in Canada. So there's very little room for the government to maneuver. And yet at the same time, they spent an awful lot of money and need to be able to cover their debts and start paying it back. So really, what other options does the government have? And they really don't have many others. So as a consequence, I think it is quite likely that we will see an increase in the inclusion rate, certainly to 66%, maybe even up to 75%. And they might even get rid of this, advantage of capital gains altogether and turn it into ordinary income. They might do that for higher earners only, where it's 100% included if you're at the top marginal rate already. They could do things like, partially reduce the exemption for principal residences and say only the first 300,000 or 500,000 of capital gains is tax-free. But in combination, there is absolutely no place else for the government to go.
Interesting. Well, that's unfortunately a bit of a scary thought for a lot of us out there. So if I do own stocks, for example, is there anything specifically that I can do about it?
Well, there seems to be a pattern that prior to the budget coming out, you see sort of a flurry of selling. So what people would do is they say, okay, well, I'm way up on this stock. I may as well take some of my profits. I may as well sell out and lock in my capital gains tax rate now. And then, it's always possible to get back into a stock later. Technically, it is possible for people to basically take their profits, and do so sort of in the run up to the budget. And we certainly saw that in the run up to this budget in the spring.
Gotcha. So if I own, let's say, other property, like either physical businesses or real estate, is there anything I can do about those?
Interestingly, yes, there are ways you can what's called crystallizing your lifetime capital gains exemption, or crystallizing capital gains. It usually involves rearranging your share classes and triggering a gain. Now, you have to be very careful about it. Certain of those triggering events will not qualify for Canadian tax purposes. You have to be very specific about how you go about it. But it is possible to effectively say, okay, 2 days before the budget, I own a business. I am going to trigger my gain. I'm going to take my lifetime capital gain exemption now. and I'm going to trigger capital gains now, and I'm going to pay some tax in the following spring, rather than risk it going up. We actually saw a large number of those sort of rearrangement transactions prior to the previous budget, and I'm expecting to see more this year. There's a certain amount of reticence on the side of the government to do anything while we're still kind of in the depths of a recession. But as soon as we come out of that recession, particularly if the current government has received a majority mandate after an election, then we're very likely to see just sort of a slew of these transactions go through.
Interesting. Well, I appreciate you sharing on that front. So I guess before we kind of close up here, any sort of final thoughts on the subject of capital gains in general, whether it be domestic or abroad?
Well, I think one of the differences between the Canadian system and virtually every place else is that the sale of your principal residence is tax exempt in Canada and has been for a very long time. Now, that I think has distorted the Canadian domestic market, making a great deal more investment into real property than is really safe or appropriate. And so I think it's very possible that the government could do something like exists in the US, where only the first $300,000 of capital gains on your principal residence would be exempt. And that policy might be very effective simply because in every place but Vancouver and Toronto, it's a non-tax. No one would ever pay it. There's a lot of people whose houses aren't worth $300,000, so there could never be $300,000 in gain. Whereas that same policy would have a very sharp impact on Vancouver and Toronto and might actually tamp housing speculation down. So, I think it's very possible that we could see that kind of a shift in Canadian tax policy. And the reality is it wouldn't necessarily be a bad thing.
Gotcha. Well, Jonathan, I really appreciate your insight. Always a lot of nuggets of real interesting points in there. So thank you so much for taking time out of your day to join us. Hopefully this is of value to everybody, and we look forward to having you on again soon.
Thank you.